Hello viewers, I welcome you to a fresh episode on the chapter of the firm Financing and Managing. In this episode, we shall study the meaning of firm as an agent of production. We'll study how the decision taken by the firm and what is the legal forms of the firm. We shall also discuss the corporate finance and its sources. We'll first acquaint ourselves with the terms which are going to be used in the discussion. But we must first understand the following basic concepts before proceeding further. The firm is an agent in the economy that produces goods and services to satisfy wants of the people. In this productive activity, it transforms inputs such as labor, raw materials, and natural resources into useful products which are demanded by the consumers. Firms exist to use scarce resources of the society efficiently and thus help the economy to cope with the basic problem of scarcity. Business firms exist for three main reasons. First, they exploit the economies of mass production. Second, they raise funds to finance its productive activities. And third, they organize the production process. The most important reason for organization of production in firm is that it enables us to take advantage of the economies of mass production. Efficient production of goods require the use of specialized machines and factories, assembly lines, and division of labor into small operations which are performed by special groups of labor adequately trained for the operation done by them. Firms coordinate the process of production. They hire labor, get land or building and capital on rent, purchase raw materials, and arrange for electric to undertake the process of production. Emphasizing the need for organizing production in firms, Professor Samuelson writes, "If there were no need for socialization and division of labor, we could each produce our own electricity, digital watch, and fine spun shirt in our backyard. We obviously cannot perform such feats so efficiently generally requires large-scale production in business firms." The second important function of a firm is raising of resources for large-scale production of goods and services. A modern steel plant requires more than 200 crore of rupees to be set up. The expenditure on research and development to devise and develop a new type of aircraft might require even more funds. They supply wealthy individuals who is in the past used to provide resources for production. Today, in a private enterprise economy, the business firms are able to raise a large amount of funds through selling shares or bonds to millions of people, borrowing funds from financial institutions, and plugging back their own profits of financing production. The third important reason for the existence of firms is management by someone who organizes production, arrange the required financial resources, introduce new products and processes, makes other businesses decisions and bear risk and uncertainty, and is responsible for the success and failure of the business venture. To quote Professor Samuelson again, "Production is organized in firms because efficiency generally requires large-scale production, the raising of significant financial resources, and careful management and monitoring of ongoing activities." To maximize profits and to use its resources for production of goods and services to satisfy wants of the buyers, the firm must make the following decisions. First, which goods and services to produce and in what quantities, which production technique to use for production of a product. Third, which production resources or inputs to use and in what quantities. Fourth, how to organize its management structure so as to coordinate the various activities of the process of production. Fifth, how to finance its productive activity, that is, how to raise resources or money capital to finance its investment in machines and factory building and pay wages to the workers and prices to the suppliers of the other inputs. Firms are divided in three legal forms. Sole proprietorship, it is a firm that is owned by a single person and is also often managed by one person. From a legal point of view, he often owns all the assets of the firm and also owes all its liabilities. The sole proprietor has unlimited liability. The unlimited liability means that the proprietor is legally responsible for all the debt of his firms up to his entire private wealth owned by him. Responsibility for the success or failure of the firm entirely rests on him. If the sole owner of the firm is not able to pay back his loans, creditors who have given him the money can claim his personal property. A large proportion of farmers in India are sole proprietors. Many retail stores, cottage and small-scale industries also fall under the category of sole proprietorship. The sole takes all the managerial decisions and also profits, if any made by the firm, goes to him alone. The profits along with his income from other sources constitute its personal income on which he pays income tax. Second, partnership. A partnership is an association of two or more persons who enter into an agreement to establish and carry on business as co-owners. Thus, in contrast to the sole proprietorship, in partnership form of business organization, there are at least two persons who own all the assets and have unlimited liability. Partners agree on appropriate management structure of the firm and also how to distribute profits among them. Usually, the form of sole proprietorship get transformed into partnership when the sole proprietorship has an idea to expand business but lack necessary funds to do so and decides to associate another person who is interested in his new business venture and agrees to contribute a part of finance to expand either the established business or set up a new business venture. In this way, by associating more persons, an entrepreneur can obtain the necessary finance to form a partnership firm. As in case of sole proprietorship, profits received by each partner are taxed as personal income of partners. But it is worth mentioning again that each partner has unlimited liability, that is legally responsible for payments of all debts of the partnership firm, of course limited only by the amount or private wealth he owns. Third, corporation. The bulk of production in advanced developed countries is done by the corporations, which are also called joint stock companies or public limited companies. Unlike a sole proprietorship or partnership, the corporation is a separate legal entity from the person who owns it. The ownership of a corporation is vested in the shareholders who own shares of the stock of a company. Therefore, the alternative name of corporation is a joint stock company. The chief feature of a corporation is that the liability of each shareholders is limited to the original value of the shares of the company owned by him. The limited liability of the shareholders implies that if the corporate company goes bankrupt, the private wealth of an individual shareholder of the company cannot be used to pay the debt of the corporation. This is a great advantage of the corporation, which enables it to raise a large amount of funds from the market. As a result, the corporation is able to produce on a large scale and enjoy economies of scale. The stock of a corporation is divided into shares of a certain face value. The shares can be sold in the stock market such as Bombay Stock Exchange or Delhi Stock Exchange or Calcutta Stock Exchange, etc. Being a separate entity, a corporation can buy, sell and hold property in its own name, borrow money from banks or other financial institutions, and can enter into contracts with suppliers, labor unions and others. Large corporations have a quite complex management structure headed by a managing director or chief executive officer (CEO) and senior vice presidents. Various senior managers look after the separate areas such as production, finance, marketing, research and development. Besides, there are specialists and experts who help the senior managers in their work. The corporation raises its financial resources by selling shares to the public. Those who buy shares of the corporation become its owner and are called shareholders. Corporations also raise finance through selling debentures or bonds to the public, and on these debentures they pay fixed rate of interest. The corporation also raise their finance through borrowing from the banks and other financial institutions. Profits of a corporation are taxed separately, that is, independently of the incomes of shareholders. In India, there is a corporation tax levied on the income or profits of the corporation or public limited companies. Shareholders pay income tax separately on the dividends received by them. In fact, there is a double taxation of income of the corporation. First, the corporation tax is levied on the profits of the corporation, and secondly, dividends paid out of these profits and received by shareholders are taxed under the personal income tax levied on the individuals. Besides, shareholders also pay capital gains if they gain from buying and selling shares of the public limited companies. Capital gain is the gain received by the shareholders when they sell the shares held by them in the market at the price higher than they bought these shares. Corporations do not distribute its entire profits made in a year among shareholders, but retain a good part of them for the purpose of expanding business and increasing investment. These are called retained savings or undistributed profits. The following are the important features of the corporate form of business organization. First, the ownership of the corporation is vested in shareholders. The extent of ownership by a shareholder is determined by the original face value of the share held by him. It is important to note that the individuals who buy bonds or debentures of the corporation are not the owners, they are creditors of the corporation. The capital value of the shares held by individual fluctuates as price of the shares in the stock market change. When the price of the shares of a company rises, the capitalized value of the share rises and capital gains occur to the shareholders. Separation of management from ownership. A chief feature of a corporation is separation of ownership from management. In theory, shareholders who own the corporation and control it as well. However, in practice, millions of shareholders of companies like Reliance, Infosys, Tesco are also widely dispersed that they exercise virtually no control. Most of the shareholders are merely interested in collecting dividends which they get in proportion to the shares they own and are interested in rising share prices which give them capital gains. Of course, shareholders elect directors and in annual general body meeting vote on many important policy issues of the company. Management of the corporation is done by salaried managers appointed by directors of the company. Thus, shareholders who are the real owner of the corporation do not have any direct control over managers. It has been observed that managers often work to pursue their own interests which clash with those of the shareholders. Thus, there is an agent principle, the agents are the managers and the shareholders are the principals. If profits of the shareholders are to be maximized, this agent principal problem has to be resolved. Third, the control and decision making by directors and managers. The directors and managers of a corporation make business decisions such as what to produce, how to produce, what price of the product to charge, what investment to expand business, and so on. They negotiate with workers about wages to be paid and other working conditions. Besides, directors of the firm have to decide whether to sell the firm to someone who wants to buy it or take over it. Corporate firms have to raise crores of rupees to buy capital equipment and to finance inventory holdings. The most important ways the corporate firm raise funds are: first, selling shares or stocks to the public. This is generally called equity capital. Second, borrowing the funds by the sales of bonds to the public. This is commonly called debt capital. Third, borrowing from the banks. And fourth, plugging back undistributed profits, that is, retained savings for investment. It is important to note that the funds which firms raise for investment is generally called money capital or financial capital, and is quite a distinct concept from real capital, which represents physical assets or goods used for the future productions. We explain below briefly these sources of finance for corporate firms. First, selling stock or shares. An important way in which a corporation can raise funds for financing its business is selling of shares or stocks to the public. Finance raised in this is called equity because those who buy the shares are the owners of the firm. The shareholders who make their firms available to the firm take risk of losing them in return for getting a share of firm's profits. Though there are various types of shares of a firm, the two important types are the common share and the preference share. Shareholders who hold preference shares have the first claim to the profit if they earned by the firms, that is, they have a right to preference over the common shareholder in the payment of dividends. But the maximum rate of dividend to be paid to the preference shareholders is fixed. Common shares. Common shareholders usually enjoy voting rights and have a residual claims on profits, that is, they get dividends after all claims over the firm have been met. There is no any limit to the dividend that may be paid to the common shareholders. In case a firm makes profits, it decides whether to pay dividend or retain them for reinvestments. Some firms may decide to pay a high rate of dividend to common shareholders as percentage of money originally invested by them. Others may decide to pay a low rate of dividend. The fraction of profits to be declared as dividends depends on the policy of a firm. Funds raised through issue of shares are called equity capital. The cost of equity capital is the minimum rate of return that is required by the investors to buy the shares equity of the firm. Investors in the common stock equity capital of the firm are rewarded in two ways. First, they get dividends annually on the shares of the firm held by them. Secondly, they gain from the appreciation in the price of equity shares of the firm. However, investment in the equity capital are riskier than investment in debt capital, that is bonds of the firm, which bears a fixed rate of interest. This is because whereas bonds have to be paid a fixed rate of interest annually, the dividends can fluctuate very much depending on the rise and the fall of the profits of the firm. Besides, the prices of shares of a firm can change very much, they can even fall. Thus, investment in shares or equity capital of a firm involves a good deal of risk. There are various measures of the cost of equity capital. An important measure of cost of equity capital is that it is equal to the risk-free rate of return plus a risk premium. Note that return on long-term government securities is equal to the risk-free rate of return. Selling bonds. Firm borrows funds by selling. Bondholders are creditors, not owners of the firm. The bonds bear a fixed rate of interest called as coupon payment to be paid every year till the date of maturity. A bond is a legally enforceable debt obligation to pay a specific amount at a specific future date. Note that whether profits are made or not by a firm, the obligations of bondholders have to be met. If the required payments on the bonds are not made by the firm, the bondholders can force it to declare itself bankrupt. Therefore, in case of bankruptcy, the bondholders have the first claim on the firm's assets before any payment is made to shareholders. Only when the claims of the bondholders and the other creditors have been met in full, the shareholders can get any share of the asset of the bankrupt firm. The disadvantage to the corporation of raising finance through selling bonds is that interest payment for them must be made whether the firm makes profits or not. It has been found in practice that the firm that could survive a temporary crisis if all its capital were of the firm of share capital were forced to go bankrupt because they could not meet their contractual obligations of making interest payments to their bondholders. It may, however, be noted that the interest payment made by a firm are deducted from the firm's income to obtain its taxable income. Therefore, in order to determine the cost of debt capital, that is borrowed funds, the adjustment must be made for this tax deduction to obtain after-tax cost of debt capital. If it is the interest rate to be paid on funds borrowed through bonds and I is a marginal tax rate, the cost of debt capital RD is given by, where RD stands for cost of debt capital, RD equals to I times 1 minus T. Where RD stands for cost of debt capital. For example, if a firm borrows funds at 15% rate of interest and marginal cost tax rate is 40%, then cost of debt capital is RD equals to 0.15 times 1 minus 0.40. So that equals to 0.15 minus 0.06, which is equal to 0.09 or 9%. Let's come to the third one, that is financial through internal or retained earning. Internal savings represents undistributed profits of the corporate firm over the years which can be reinvested in one's own business. This is the easiest way for the firm to finance investment than getting required funds by the sale of bonds or issue of new shares to the public. In recent times, this has become a major source of funds for investment by the companies. As mentioned, these internal savings are accumulated by the companies by not distributing their entire profit as dividends to shareholders. If shareholders do not like the dividend policy of some companies, they can do very little about it except to sell the shares of a company to others and invest their funds in the companies whose dividend policy they like. It may be noted that cost of using retained savings for further investment in the firm itself is its opportunity cost, that is, return that could be earned by lending or investing funds outside the firm. Therefore, the cost of using retained earnings for its investment by the firm is generally treated at par with the cost of equity capital. Fourth one, loans from financial institutions. Corporate firms meet much of their short-term and some of their long-term financial requirements by borrowing from banks. This is true of not only big corporate firms but also of small corporate and non-corporate firms. Recently in India, banks have also been allowed to make investment in the equity capital of corporate firms subject to a certain maximum amount. In fact, providing loans to businesses and industrial firms is one of the major activities of the commercial banks. Beside banks, there are other financial institutions such as insurance companies, industrial credit corporations set up by government which give loans to the firms. It may be noted that cost of borrowing from the financial institution is relatively costlier to the firms. Therefore, firms prefer to raise funds through issue of equity shares. So finally, let's quickly look at what we have learned today in today's session. In this session, we have discussed meaning of the nature of the firm, decisions to be taken by the firm's legal forms, We have also discussed the corporate finance and its sources. So that brings us to the end of today's episode. We're ending here the chapter of the firm financing and managing, and we'll see you again discussing about our next topic on cost analysis. Till then, have a great time. Thank you for watching and goodbye.
Thank you.